Welcome to This Explainer. Today, we're unpacking the incredibly complex financial reality of an absolute American icon, Ford Motor Company. Look, if you follow the auto industry, you know we're in an era of massive, rapid change. But for Ford, it's honestly a story of a company literally split in two. They are caught in this intense internal tug of war, and it's basically dictating their every single move. Get this. Despite commanding a massive $57 billion market cap and absolutely dominating global truck sales, Ford stock has barely budged. We're talking a stagnant 1% growth over the past 3 years. Just 1%. To put that into perspective, while Ford was idling, close rivals like GM saw their stock surge by a staggering 130%. So what on earth is holding the blue oval back? To solve this mystery, here's our roadmap for This Explainer. We're going to look at the blue oval's paradox, the profit engines of Pro and Blue, the Model E anchor, the LFP battery bet, tariffs and supply headwinds, and finally, the road to 2026. Let's get right into it. Section 1. The blue oval's paradox, profits versus losses. This side-by-side comparison perfectly illustrates that tug of war we were just talking about. On one hand, you have Ford Pro, their commercial vehicle division, projecting an unbelievable $6.5 to $7.5 billion in profit for 2026. But on the flip side, Ford's Model E, their electric vehicle division, is staring down a massive projected loss of $4 to $4.5 billion. So billions generated by those commercial vehicles are just instantly offset by these massive EV losses. It's really like watching two entirely different companies operating under one roof. Section 2. Profit engines, Pro and Blue, trucks, vans, and subscriptions. When it comes to traditional vehicles, Ford's core strength is just completely unmatched. I mean, look at this. The F-Series actually widened its lead as America's best-selling truck, moving over 357,000 units in just the first 6 months of the year. That outsold its nearest competitor by over 80,000 trucks. Add the Explorer moving nearly 127,000 units as the top three-row SUV, and the Transit van hitting nearly 79,000 sales to keep its crown as the #1 commercial van. They are absolutely dominating these high-demand legacy segments. But what's really fascinating here is the actual makeup of those sales. High-margin off-road trims unexpectedly made up a massive 25% of Ford's U.S. vehicle mix in the first quarter. We're talking about vehicles like the Bronco, which, by the way, just set a first-half sales record and even outsold the Jeep Wrangler in Q2. Selling more of these top-tier off-road trims naturally drives up average transaction prices. Basically, Ford is pocketing a lot more money per vehicle than they do on the standard base models. And hey, it's not just about bending metal and selling tires anymore. The Ford Pro commercial division just saw its paid software subscriptions blow past 900,000 active users. That's a 20% jump in just the first half of the year. This is a total game changer for them, because software subscriptions bring in that sweet, incredibly high-margin recurring revenue that traditional one-off vehicle sales simply can't touch. So, the big takeaway here is this staggering projected growth, an 88.1% jump for the traditional gas-powered and hybrid Ford Blue division. This proves beyond a shadow of a doubt that the old Ford is performing better than ever. Their legacy business is an absolute powerhouse right now. Moving on to Section 3, the Model E anchor, the cost of transition. Here's where things get tough. The Model E division took a staggering $4.8 billion hit in 2025. And, the pain definitely isn't over yet. After posting a $777 million EBIT loss in just the first quarter of 2026, this division remains a massive drain on the company's resources. Just to put that into perspective, in 2025 alone, their overall EV-related losses hit $19.5 billion. Ouch. Like they noted right in their financial reports, this division faces a brutal dual challenge. They are trying to match their EV supply with this very wavering, unpredictable consumer demand, all while simultaneously bleeding cash to fund massive new product development and software-defined platforms. It's incredibly expensive to build the future from scratch when you're still fighting to compete in the present. Section 4. The LFP battery bet, driving down EV costs.
To stop this cash burn, Ford is making a major pivot toward LFP, or lithium iron phosphate batteries. This drastically lowers their reliance on expensive materials. LFP batteries cost roughly $73 per kilowatt hour, compared to $93 for your traditional NMC batteries. This is an absolutely crucial step if they want to compete with cheaper overseas rivals, especially the Chinese automakers who are currently dominating LFP production.
Let's see how this actually builds into their long-term roadmap. First up, Ford is assembling these LFP cells domestically at their Blue Oval Battery Park in Michigan. Second, using these cheaper batteries will pave the way for a highly anticipated $30,000 electric pickup truck to challenge rivals like Ram and Chevy. And third, through all these cost savings, they're aiming to finally get that EV division profitable. Though, realistically, they aren't expecting that until 2029.
Section 5. Tariffs and supply headwinds, external pressures.
Even with a solid plan, these external supply chain disruptions have really hurt them. They got hit with unexpected tariffs totaling nearly $900 million. Plus, there was a disruptive fire at a Novelis aluminum plant in New York that heavily bottlenecked the production of their most profitable vehicles, like the F-150 and the Expedition. Because of all this, we saw elevated inventory levels, hitting 113 days supply for the Ford brand and 142 days for Lincoln. Combine that with a 69% drop in daily rental sales, and, well, you have the primary culprits behind Ford's largest quarterly earnings miss in 4 years, which we just saw in Q4.
And management is dealing with some incredibly frustrating math right now as a result. While Ford actually anticipates about $1 billion in tariff-related benefits this year, those gains are unfortunately going to be completely wiped out by $1 billion in higher costs just to source aluminum after that supplier fire. It's literally a zero-sum game for the balance sheet this year.
Section 6. The road to 2026. Rebound and resilience.
Now, despite those immediate hurdles, there is some surprising optimism. Buoyed by the immense profitability of those off-road trims and commercial fleet services we talked about, Ford actually raised its full-year adjusted EBIT guidance to a range of $8.5 to $10.5 billion. They're also projecting strong free cash flow between $5 and $6 billion. Now, sure, this assumes we avoid a U.S. recession or any prolonged geopolitical disruptions, but it sends a really strong signal to the market that their core operations can weather the current storm.
What you should really take away from all this is that Ford is leaning hard into what it does best. They are aggressively engineering iconic, gas-powered, and hybrid vehicles to maintain their retail market share. They're pushing these high-margin products to customers even as they phase out older, lower-volume models like the Escape. They know for a fact that their traditional trucks and SUVs are the lifeblood keeping the whole company going right now.
So, as we wrap up this explainer, we are left with this fascinating paradox. The legacy business is generating unbelievable cash, but the electric future demands totally unprecedented investment. The ultimate question for the stock's future is this: can the Blue Oval win this internal tug-of-war and reach EV profitability by 2029? Or will the market just give up on its transition before they even get there? It's a high-stakes balancing act, and you can bet the entire automotive world is watching closely. Thanks so much for joining me today, and keep your eyes on the road ahead.